You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Year-on-year inflation keeps on slowing, the unemployment rate is low, and economic growth is strong. Does this mean a so-called soft landing is on the way? Our guest today will be Chris Lowe, Chief Economist with FHN Financial, who will share his views on the likelihood that inflation comes under control without the economy slipping into a recession. We'll also give a quick market update on what's driving financial markets now and what you should look out for in the weeks and months ahead. Stay tuned. Coming up soon, our interview with Chris Lowe, Chief Economist with FHN Financial. But first, a quick market update. The Fed hiked 25 basis points this week, as expected. With no new economic or rate projections this meeting, the focus was on the wording of the FOMC statement and Chair Powell's press conference. Much to the frustration of market participants, the statement barely changed and there was very little new information in the press conference. Inflation is still in the driver's seat for Fed policy, especially with the tight labor market and strong economic growth. Speaking of which, the first release of second quarter GDP this week showed 2.4% annualized growth, above the consensus expectation and strong enough that the Fed can worry a bit less that monetary tightening so far is tipping the economy into a recession. The June PCE data showed core PCE inflation rose 0.2%, equally encouraging as the June CPI, but at the risk of sounding like a broken record, this is only 1 month of data. We've seen head fakes before, and the Fed needs to see persistent improvement before any plan for rate cuts. Treasury yields have bounced back after a bond rally earlier this month. 10s pushed through 4% this week, and 2s are back above 4.9%. The market reaction to the FOMC and important data the second half of this week has been a little shaky so far. We think it will take until early next week for markets to settle down. Market expectations currently show about 50-50 odds for an additional rate hike sometime this year. Not entirely consistent with the Fed's last dot plot, but still accepting the Fed's messaging that meetings in the future are live. That's all for the market update this time. Now, our interview with Chris Lowe. Our guest today is Chris Lowe, Chief Economist with FHN Financial. Chris, thanks for coming on the podcast.
My pleasure, Will. Thanks for having me.
Our topic today is the prospect of the economy achieving a soft landing. So before we get into anything else, I just want to quickly define a soft landing as I see it. So I would define a soft landing as the scenario where inflation comes down to the Fed's 2% year-over-year target without there being a recession. And sometimes people specifically point to a meaningful uptick in the unemployment rate, though how big that uptick needs to be is a little open to interpretation. So Chris, before we go into the discussion, any qualms or anything to add about that definition of a soft landing?
Yeah, I think, the goal, right, is to normalize inflation. That's the Fed's primary concern right now, as it is at the late stage of any cycle when they're tightening. So, yeah, I think you're absolutely right. Effectively, if you can stabilize inflation without a recession, therefore allowing the expansion to continue, that's a soft landing.
As we record this, the last batch of CPI inflation data we saw, which was for June, showed year-on-year inflation coming in at 3%, which is not 2%, but it's a big slowdown from the peak of 9.1% last year. Supply chains are showing better balance. Energy prices are staying under control after all the potential risks from Russia's invasion of Ukraine. And all the while, the employment rate is at only 3.6%, which is where it's been for a while. And we've had just about a year of positive economic growth. So it sounds like that is a textbook soft landing. Or if not, it's just a few months away. So what do you think is missing from that description of the economic landscape?
Well, you're absolutely right. Especially just given what's happened to inflation in the last couple of months, right? The CPI was 4% even in May, 3% in June. At that rate, it'll be 2% in July. Why am I skeptical that we can get to 2% even a year from now? The reason is that the rapid improvement in inflation we've seen in the last 6 months or so is primarily the end of the explosive inflationary impact of the first few months of Russia's war on Ukraine. Inflation, of course, was already running pretty hot before that war began, but specifically in the first few months after the invasion, oil prices and food commodity prices skyrocketed. They've been coming down since last June, but they have stabilized since December. And for that reason, those year on year inflation comparisons start getting more difficult. And in fact, they start getting more difficult as soon as the July report. So uh, let's just say, I guess, the easy work is behind us. And what now becomes the more challenging work on inflation is pulling down the cyclical components, things like rent, things like wage heavy services that are in part running hot because the economy is tight and labor's hard to find. And we've had a few years of solid income growth.
I think it's helpful to look at these stickier components of inflation, or the cyclical ones, as you call them, because that's the inflation that's left over once all the other imbalances in the economy, like rising energy prices or supply chain bottlenecks, normalize. And to understand the stickier parts of inflation, it's helpful to specifically look at the labor market, because it is at the heart of how the Fed views inflation. The Fed really thinks that the strong labor market right now is reinforcing high inflation. And that's where they get this emphasis on what they call the supercore, or services prices excluding energy and shelter. And for those who aren't totally familiar with the terminology, a good is something like your iPhone or a piece of furniture, and a service is something like your insurance salesman or your daycare provider. And the thinking is that the primary operating cost for service providers is the cost of labor, wages. And wages are not flexible, they're sticky. They don't change as quickly as the price for a gallon of gasoline or even consumer goods, where retailers can stick a discount sticker on the shelves when demand goes down or they order too much for the holiday season. So the supercore inflation means that wage increases are closely tied to the consumer prices for these categories. When the labor market is strong and employers are competing for scarce workers, this keeps wage pressures elevated, and that gets passed on to consumer prices. Chris, do you agree with the Fed's understanding that underlying inflation can only come down if the supercore meaningfully slows down?
I think it makes a certain amount of sense. Consider just one industry where there have been particular labor shortages, restaurants. In restaurants, we not only have seen rapid wage gains because companies are competing for scarce workers, but we've also seen really rapid inflation. It's one of the bigger contributors to the CPI in the past year. When you compare what it costs to eat out relative to cooking for yourself, inflation for food away from home has gone up a ton more than inflation for food at home. So there is some empirical evidence, even in just the last couple of years, that it makes sense to worry about wages. I do think it is possible for inflation to come down anyway. But I also think it's really important to remember that when the Fed dismantles inflation, that they don't ignore all the other pieces. They are still watching them. And Chair Powell gave a speech last year where he talked about why they took the PCE deflator apart and drilled down to the supercore. And it was because they have a pretty good sense for what the other pieces are going to do. One of the things I'm a little worried about is that not all of those other pieces are behaving as well as the Fed anticipated. Just to give one example, goods prices, excluding food and energy, they figured would fall back on the long term average, which is about zero. They don't rise in price. But in fact, they are still rising in price. in part because the whole world is decoupling from China. They're moving their or diversifying their suppliers to other markets, and that's proving to be expensive, keeping at least a little upward pressure on those goods prices.
I think that's a really good point that the reliance that the Fed has on its super core inflation, where you get to the center and things are tied to the strength of the labor market, it's under the assumption that food and energy and supply chain imbalances, that everything zeroes out and improves. But of course, if that doesn't happen, there's an upside risk. I kind of want to push back on the other assumption though, which is the connection to the labor market that the supercore has. Um, so, this idea of services being primarily driven, operating costs for services being primarily driven by the cost of labor. If you look at the components of things in the services category, I think the better title for it is not goods, because it really just encompasses so many components that aren't all that similar. And so I'm just going to give some examples of how I think the wage, the kind of idea that it is primarily wage driven is not as strong as the Fed is really leaning on. And I think this could show some inflation improvement without necessarily causing the labor market to need, significant weakening. So the first example is airfares. So this is included in services. But airfares, we've seen those prices fluctuate, not because the wages of pilots or flight attendants, but it's more closely tied to jet fuel. For car rental and auto repair, those prices went up earlier in the pandemic, not because the wages of the repair people or the person behind the car rental desk went up. It was because the semiconductor microchip shortage caused a shortage of cars. And so that, you could see those prices being flowing downstream from the goods market instead of being driven by the wages. And then something like internet services. Early on in the pandemic, we all needed to double our bandwidth because we were working from home and we were streaming videos and all of that. And these internet providers, they didn't double their workforce or they didn't double their wages. Instead, there was capital intensity where they could scale up without really causing an increase in prices. And so you kind of go through a lot of these components, and a lot of the services sector is driven by things that aren't the wages of its workers. And so I see that as a potential for if kind of the imbalances in the economy are able to equalize and come into harmony, it could bring those prices down without necessarily having to sacrifice wage gains or unemployment.
I think that's true up to a point, absolutely. And I mean, airlines are the best example. But another thing to consider with an industry like the travel industry is the demand side, and to a large extent, the money we have to spend on services like air travel depends on what our wages are doing, what people's income is doing. When you look at airline pricing, for example, when the airplanes are relatively empty, pricing almost directly correlates to jet fuel prices. That is, airlines manage their prices against their cost basis. And as you said, their costs are dominated not by salaries, but by fuel. On the other hand, when planes are overbooked, when the airports are packed, then you very often see that airfares will rise even when fuel costs go down. It becomes more of a supply demand relationship. And the demand is very much driven again by income growth and wage growth. So I think in that sense, the Fed is right that what makes wage pressure so insidious in the eyes of the Fed is not just that wages are a cost, but also that wages provide the wherewithal for consumers to tolerate price increases. If they don't have income growth and prices rise, eventually they're going to cut back, and companies will find that their revenue actually drops when they raise prices because they start chasing customers away. But if there's solid wage growth under spending, then it becomes easier to raise prices. And that's the other piece, of course, that the Fed focuses on.
I think that makes a lot of sense because, of course, when the labor market is strong and we're adding 200, 300,000 jobs a month, that is more labor income, just more money for people to spend on stuff. And of course, if that comes up against a supply side of the economy that can't keep up, prices will go up. But so does the Fed then have too much of an emphasis on looking at the micro side of it, looking at the wage driven or so-called wage-driven components of the CPI, rather than just thinking, well, a strong labor market means that there's an imbalance in the economy between supply and demand?
I think, frankly, at the Fed, that they're open to thinking about all kinds of things because their inflation models just haven't worked very well for the last 30 or 40 years. So, the idea that the way they're looking at it, the way they think about it is perhaps too simplistic. Um, I don't think even within the Fed they would argue with that. Of course it is. And so, one of the things we have to bear in mind when we think about the possibility of a soft landing is what if inflation does continue to slide and the unemployment rate stays low? Is the Fed going to continue to aggressively tighten? And I think the answer to that we saw late in the last cycle until, unfortunately, the pandemic ended the expansion. The Fed abandoned hiking rates, even at a point where most of the Federal Open Market Committee thought further rate increases were necessary. And they did it because inflation was low and because even though the unemployment rate was lower than they thought sustainable, the economy was starting to stall. And they figured as long as inflation was low, it was best to avoid that stall. I think what makes a soft landing particularly difficult in the current environment is that, as you started the podcast with, inflation is not low. Inflation is still higher than the Fed's goal. That is a big difference between the current environment and what we had in 2019. It is much more difficult. In fact, I think many economists would argue impossible for the Fed to pull off a soft landing when inflation is running above its target.
I want to describe another scenario that could lead to a soft landing. I want to hear your thoughts. This idea, I think I've seen it described as rolling recessions. So certain sectors, certain industries have corrections. They come back into better balance after this period of overheating the last couple of years. But they do it in a way and kind of sequentially in a way so that there is not an economy-wide recession. So I think we've seen two rate-sensitive sectors that can give an example of this and perhaps provide a path to a soft landing. So the first is tech, where we saw huge growth, huge increase in employment when money was just free and lots of investment in tech companies. And then when interest rates went up, we saw a big contraction, a bunch of layoffs. And then right now, things have leveled off, and the tech industry, more or less, as far as we can tell, has seen a correction without a huge collapse. The second industry then would be housing, where again, we saw a huge surge in sales and house prices earlier in the pandemic when money was very cheap and people wanted to migrate somewhere for more space during the pandemic, maybe to work remotely or just have an investment in a second home. And then as interest rates went up, home sales cratered. And then as far as we can tell in the last few months, perhaps through really the beginning of this year, things plateaued. And so the housing market had this correction without it breaking. And I kind of bring this up because I think if we see each sector come into balance, not at the same time, in my mind, it's possible to avoid a recession because employment can be reallocated to sectors that are having difficulty hiring. There's not a huge collapse in consumer spending or sentiment that would cause investment to really decrease. And so, as long as these sectors and industries are able to harmonize, to come into better balance, not at the same time, could there be a possible path to a soft landing there?
The first time I heard the term rolling recession was in the late 1980s when I started in economics. It was kicked around again in the 90s, and actually it was a lot more appealing in the 90s as a possibility because it followed a true soft landing. We had a soft landing when the Fed tightened in 94, 95. It's one of less than a handful in the last 40 or 50 years. But what tends to happen in an economic cycle, even when things are going right, and you have these rolling corrections, sector by sector, what tends to happen is that the Fed continues to tighten with the idea that they ought to normalize the rate of job growth to be equal to the rate of labor force growth. If there's 100 to 150,000 people entering the labor force on average every month, then that's the non-inflationary rate that job growth that can be allowed. What's tricky about that then is that economic growth is relatively close to zero. On average, it's probably somewhere in the neighborhood of 1 to 2%. But of course, every quarter differs, and some are going to be above that, some are going to be below. Just looking back at the last few years, we've had tremendous variability in the growth rate from quarter to quarter. And what happened in the late 90s, what happened again 10 years later or so when the next cycle ended, is that you're skating very close to that edge, and there's a shock in the economy of one kind or another. And it is the shock that triggers the recession. But the economy is vulnerable to recession because it is operating at such a low level of growth. Once you tip over and growth goes from positive to negative, even if it is a shock, even if it is something that ought to wear off fairly quickly, what happens is that companies begin resizing their workforces. They let people go. And then it becomes self-reinforcing for a time. That's what causes the recession to become more widespread. And even those sectors that may have already corrected, they could very easily correct again. I don't see anything right now in the data suggesting that a recession is imminent. In fact, the leading indicators look a lot clearer now. That there's less to worry about than there was 6 months ago. So I'm pretty optimistic about growth continuing for a time. But rolling recession is one of those things that we've seen the economy approaching one. We've seen rolling corrections before, but it always seems as if when economic growth is slow, there's some catalyst that comes along and transforms a rolling recession into a real one that's economy wide.
I do agree that the fundamental economic statistics right now are not pointing to a recession anytime soon. I will say in your last forecast write up, which was in May, I won't hold you to it. You can correct anything I say here because I'm sure there have been updates. But your main thinking was that a mild recession was going to happen instead of a soft landing because the Fed would engineer it. The Fed would need it in order to bring inflation down. And that's when their job is done, is when they restore price stability. But you did give a non-zero probability to a soft landing. So, what do you think are the needed conditions for this to actually happen, even if it's not the most likely scenario?
Well, as I said, it would be extraordinary if we could pull one off, because the Fed is still trying to manage inflation lower than it is at the moment. So as long as their focus is on keeping policy tight and causing growth to slow, and in fact, based on all of the communication from the last Fed FOMC, the goal is to boost the unemployment rate. Um, Soft landing, I think, is a very low probability, but it is possible, and it's possible primarily if inflation stabilizes and the Fed abandons trying to push the unemployment rate higher. As I said, I don't think that's entirely far fetched. It is consistent with the way the Fed has behaved in the past. I think it could happen again. But the first ingredient is absolutely necessary, and that is inflation has to come down to 2% or lower.
For the last couple of years, we've seen very few moments where market expectations seem to be in line with Fed communication, with economist consensus, all of that. So, right now, in the middle of July, as we record this, we still see this divergence between the Fed's last dot plot in June and market expectations for rates. I think there is also then a difference between market expectations and your forecast. So, what do you think is then the most important message for investors the rest of this year, based on how you see the economy and rates playing out?
I think we're definitely in the end game in terms of tightening. That is, we're getting close to the peak level of interest rates. I don't think we're there yet. There is a majority on the Fed that believes rates have to go up. And what is striking, as you pointed out, is the market doesn't think rates will go up as much as the majority of Federal Open Market Committee participants think, which is pretty remarkable when you consider we're talking about a group of about a dozen people who are going to vote and actually choose where to set interest rates. They don't necessarily consult with the market before making that choice. So I would think as an investor, for a starting point, what the Fed says tends to be more useful than what the market says about where the peak in interest rates is going to be. I would add to that, though, that you can also look at the Fed's interest rate forecasts over time. How has their thinking evolved, and why has it evolved? And what's most striking to me looking back over the last 2 years is that the Fed's sense of where the terminal rate would be, the peak level of the federal funds rate, it has increased in every single one of the Fed's quarterly estimates, except the one at the meeting that just happened to be a week after those big bank collapses in late March. But other than that one meeting, they've increased it every time. And the reason they increased it every time is that they went into the meeting and saw that the financial response they expected from the tightening they'd done so far proved to be elusive. In other words, they hiked rates. They thought growth would slow by a certain amount. They thought unemployment would rise by a certain amount, and it didn't happen. And that was the story quarter after quarter for the last couple of years. So, with that in mind, I think if anything, the risk is they'll tighten more than they're currently saying, because even now the economy is reaccelerating. The unemployment rate is holding at 3.6%, which is where it was in March when they started tightening. Their goal is 4.5. And GDP growth is, we're putting in a solid 2% performance in the first half, and it could end up being even better than that, particularly once all the revisions are in. Their target at the beginning of this year was a little less than 0.5%. So again, as long as the economy outperforms, given what they thought it would do in response to tightening, that tells me they're going to reach for more, not less.
Chris Lowe, thank you for coming on the podcast.
Thank you, Will. It was a pleasure.
That was Chris Lowe, Chief Economist with FHN Financial. I think a really interesting and important point about Chris's understanding of the relationship between inflation and the labor market right now is that the resilience of the economy so far to Fed tightening doesn't prove the likelihood of a soft landing like I think many market participants see it. Instead, that resilience means the Fed needs to work that much harder in order to bring inflation down to the longer-term 2% target. Looking ahead, we'll see the July employment report on August 4th and the July CPI report on August 10th. We'll see one more of each monthly report before the Fed's September 20th decision. That leaves a lot of time and a lot of data for Fed officials to figure out their next step for rate policy and communicate it to markets. With markets not entirely convinced the Fed will hike one more time this year, and our expectation that at least one more hike is on the horizon, there's certainly upside risk to 2-year Treasury yields the next few months. 10s should stay within their 3.5% to 4% range we've seen since March bank tensions somewhat faded. In the meantime, big surprises to economic data and big public comments from Chair Powell are more than capable of causing 10 to 15 basis point intraday swings for coupon securities. As the end of the cycle comes closer, the important focus will shift to the terminal rate, how long the Fed holds rates there, and then how quickly they start cutting rates. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions, comments, or concerns. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. The views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.